panic selling isn't caused by bad investing strategies. It's caused by human psychology. Most investors don't lose money because they picked the wrong stock. They lose money because they reacted emotionally at the worst possible moment. When markets fall sharply, logic doesn't disappear overnight. Fear simply becomes louder than reason. At the core of panic selling is something called loss aversion. Humans feel losses about twice as intensely as gains. Losing $10,000 hurts far more than the joy of making $10,000 feels good. When portfolios turn red, the brain interprets it as danger, not discomfort. It activates the same survival instincts we use in real physical threats: fight, flight, or freeze. In markets, that instinct usually becomes flight. Another powerful driver of panic selling is uncertainty. Investors don't panic when things are bad. They panic when they don't know how bad things could get. Headlines, breaking news, and constant updates amplify that uncertainty. Every alert feels urgent. Every red candle feels like confirmation that things are falling apart. When answers are unclear, the brain fills in the blanks with worst-case scenarios. Then there's herd behavior. Humans are social creatures. We look to others for cues, especially in stressful situations. When investors see markets selling off and everyone online talking about crashes, recessions, and exits, the brain assumes the crowd knows something important. Selling feels safer when everyone else is doing it, even if it's objectively wrong. Following the crowd feels like protection. Media plays a massive role in this cycle. Fear sells. Dramatic headlines get clicks. Market downturns are framed as disasters instead of normal parts of investing. Words like collapse, wipeout, and bloodbath create emotional urgency even when the underlying fundamentals haven't meaningfully changed. The brain responds emotionally long before logic has time to catch up. What makes panic selling especially destructive is when it tends to happen. Historically, panic selling occurs near market bottoms, not tops. By the time fear feels unbearable, much of the damage has already been done. Investors sell after declines, lock in losses, and then hesitate to re-enter when markets recover. This creates a cycle of selling low and buying high, even though no one intends to invest that way. Another psychological trap is recency bias. Investors overweight what just happened and assume it will continue. If markets have been falling for weeks, it feels like they'll fall forever. The brain struggles to imagine recovery during periods of stress. This is why market bottoms feel terrifying in real time and obvious only in hindsight. Ironically, long-term investors who succeed aren't immune to fear. They've just learned how to manage it. They accept that volatility is the price of admission for higher returns. They expect drawdowns. They understand that markets reward patience, not perfect timing. Instead of reacting emotionally, they rely on rules, plans, and long-term frameworks. The real enemy of investors isn't volatility. It's emotional decision-making under pressure. Panic selling doesn't protect capital, it transfers it. It moves money from emotional investors to patient ones. Markets don't punish ignorance, they punish emotional reactions. Understanding the psychology behind panic selling doesn't eliminate fear, but it gives you awareness, and awareness creates control. The goal isn't to predict the market, it's to avoid self-destructive behavior when fear is at its loudest. Because in investing, the biggest threat isn't the market crashing, it's you selling when it does.